What is up, guys? It's Scott with Neverhead, back for another stock video. I got a recent comment on one of the other videos from a Mr. Mountain Climber asking if I can please cover SENS, SENSEONICS Diabetic Company. And Mr. Mountain Climber, I'm going to honor your request and go over some DD that I found on SENSEONICS. Let's get right into it, guys. So this is just a brief overview that I found on Reddit, but then we're going to get into some other stuff that I found, including some huge institutional buys from a hedge fund from just a couple of days ago that I think could be pretty significant. Right into it. Obviously not financial advice from Mr. Whiskey Mill. So SENSEONICS is a Maryland-based medical technology company with a market cap of about $1.5 billion. They focus on glucose monitoring devices. They have developed a new implantable device that a medical professional will put in, then diabetics can use a sensor to track their levels without fingerprints or anything like that. This is a really good idea because there are, I believe, a third of the country of this big fatty country, America, is either pre-diabetic or diabetic. So, and that number is only going to increase in the coming years as we get fatter and less healthy. So focusing on diabetes, I think, is a really good position to be in if you're a biotech company, especially after everyone was home for 3 months straight last year and put on about 20 pounds each, according to a survey that I read the other day. So I'm sure the number of big fat diabetics in the country will only increase in the coming years. Anyways, they wanted to bring their new long-term monitoring device to market sooner. But due to the pandemic, the FDA reassigned employees from approvals to pandemic-related activities. This has pushed approval to 2021, potentially very soon. In the meantime, without FDA approval yet, the company has been racking up some good press, including getting approval from issuers to cover their device. That's huge. It'll be covered by insurers, right there. Closing a stock offering and kicking off European sales, re-upping their offering due to demand for their tech, and even announcing they will participate in a global conference about medical tech. These are all great signals for a device that hasn't hit the market yet. The company has a history with successful products of this nature, and as of right now, there's no reason to think that the new product won't be a smashing success. So, let's get into their products. So, Eversense is their main product right now. This is a 90-day constant glucose monitor. It's really good because if you know anyone with diabetes, they constantly have to monitor their glucose by pricking their finger and taking a little bit of blood and then getting a reading off that, making sure their blood sugar is not too high or too low. This gets rid of that pain point by just implanting a little microchip. I know people are freaking out about microchips right now during the pandemic, and this is not invented by Bill Gates, guys, don't worry. So we have a nice little fluorescent sensor and a transmitter that is water resistant. I guess it'll vibrate if your sugar's too high or something. They have a nice little mobile app here. And this, we found out that it is covered by insurance. They are planning to increase the device to a 360-day wearable microchip and little glucose monitor. They're looking to get approval for their device for 180 days instead of 90, and looks like we haven't gotten FDA approval yet. We do have, let's get into the institutional holdings, which is, let's go down here to my Fintel account. So on April 23rd, Highbridge Capital Management Group, LLC, ordered, looks like 15 million more shares, a change in 189%, and they now own 5.08% of the company. There's a change of 62%. Let's get into a little bit on Highbridge Capital Management, and looks like this is a pretty big portfolio valued at $2.6 billion. They got 117 positions open. They opened 5 positions. They closed 24. Let's go to other institutional investors. So we have Roche Finance, Gilder Gagnon Howe, George Soros, When he's not funding BLM, he's funding diabetes research. At least that's one good thing he's doing. Masters Capital Management. And now we will go into the short interest. So short volume ratio is sitting at 31%. Let's get to the short squeeze score. So the short squeeze score is a result of a sophisticated multi-factor quantitative model that identifies companies that have the highest risk of experiencing a short squeeze. Scoring model uses a combination of short interest, float, short borrow fee rates, and other metrics. The number ranges from 0 to 99, highest numbers, indicating a higher risk of short squeeze relative to its peers, and 50 being the average. So this is pretty close to the perfect score in the short squeeze score. That bodes well for a potential short squeeze, especially since that new rule took effect on the 22nd. Let's see if I can remember this correctly. So the new rule was basically stated that any broker-dealer that wants to short a company, they have to have 100% of the capital on hand to limit their losses. So we could see a decrease in short positions soon after that. And if we look at the charts, I mean, since then, they've been going up and up and up since, let's see, for the last week. So it went into effect. So yeah, they're up 9% so far today. I think that once the FDA gets off their ass and approves their product for 180 days, and this thing gets into the arms of the 30 plus million diabetics in this country, I think this will go. Yeah, it's going to be at least $5 once this starts getting widely adopted by the diabetic community, which is rapidly increasing. But let's see if there's anything else that I missed. Let's go over their fourth quarter report filed on March 4th, 2021. So highlights and accomplishments. They generated fourth quarter 2020 revenue of $3.9 million, primarily driven by orders to support the European installed base. The Ascensia Diabetics Care commercial transition raised $175 million in proceeds from equity offerings in the first quarter of 2021 to strengthen the balance sheet. Ascensia Diabetics Care initiated EverSense sales and marketing activities in Europe in select markets on February 1st, 2021. Very good. EverSense implantable constant glucose monitor CPT codes were added to the 2021 Medicare physician fee schedule, improving national reimbursement payment availability for implantable constant glucose monitor systems and physician services. They reduced their fourth quarter operating expenses by $13.8 million compared to the prior year period, resulting from the execution of strategic cost reductions and the streamlined operational focus. They are very pleased with their fourth quarter results, their commercial collaboration agreement with Ascensia, and the success of our recent financings. These steps conclude a strategically transformational year for SENSEONICS, and said Tim Goodnow, PhD, President and Chief Executive Officer of SENSEONICS. We believe Ascensia's commercial experience and global footprint will help grow the market for EverSense in 2021 and beyond. We are working with Ascensia to further expand commercial activity in the coming months. These collaborative efforts include developing plans for new programs designed to raise patient and provider awareness, reducing patient cost, and continually expand global access for EverSense. Let's get to their quarterly revenues. $3.9 million compared to $9 million in the fourth quarter of 2019. U.S. revenue was $0.4 million, and revenue outside of the U.S. was $3.5. Q4 gross profit increased by $10 million year over year to $2.6 million. Positive gross margin in the quarter was primarily due to the ability to fill resupply orders with existing written-off inventory, as existing patient reinsertion rates were above the expectations established in the first quarter of 2020 amid the onset of the COVID-19 pandemic. So it looks like they increased their gross profit and decreased by $8 million year over year to $3 million. So they're spending $11 million on marketing. Jesus Christ, guys. Decrease was primarily due to recent changes in our go-to-market strategy. Full year 2020 results, total revenue was $4.9 million compared to total revenue of $21.3 million in 2019. U.S. revenue was $1.1 million. Revenue outside the U.S. was $3.8 million. Gross profit increased by $2.1 million year over year to negative $17.4 million. Sales and marketing expenses decreased by $29 million year over year to 20.6 mil. Our 2020 R&D expenses decreased by 18 million to 20 million. The decrease is primarily driven by the lower clinical study costs and personnel-related expenses. General administrative expenses decreased 2.4 million. Net loss was 175 million. Interesting. Compared to 115 million in 2019. As of December 31st, 2020 cash equivalents and restricted cash were 18 million. Outstanding indebtedness was 117 million. Cash equivalents and restricted cash rose to 187.3 million in January 31st, 2021, following the equity financings completed in the first quarter of 2021. So let's get to their 2021 financial outlook. Global net revenue for SENSEONICS for the full year 2021 to be in the range of 12 to 15 million, that would be an increase over 2019. So that's good. So 2020 was kind of a lost year for them, and we can see it in their share price. So yeah, 2020 way down. Just everything shit the bed, and then 2021, boom, we're back, baby. All right, I think this is going to be really good moving forward, especially once they finally get approval from the pesky FDA. But guys, that's all I got for SENSEONICS today. If you got some value out of this video, which I hope you did, I would appreciate it if you would like the video and subscribe to the channel for more updates on stocks we like. And thank you so much. I will see you in the next video.